Family Bank listing at Nairobi Securities Exchange imekuwa na drama kubwa sana. It made some people very rich before lunch, while others very poor before dinner. Do you know why? From Kenya shillings 18 to 50, then back to 26. Welcome to the stock market. The first day of trading for Family Bank shares delivered exactly what investors love and fear at the same time. This is volatility. The stock debuted at Kenya shillings 18, surged to high of 50, dropped to a low of 22, and then eventually settled at 26. For some investors, it was a day of celebration. Watu walitengeneza pesa. But for others, it was a painful lesson in the realities of investing. So, what happened? The share price suggests strong investor demand and excitement around a Family Bank listing. So many investors rush to secure shares, pushing prices very high. However, as the price climbed, some investors saw an opportunity to lock in a profit. Wajanja wao! Increased selling pressure then triggered a significant pullback. And this is a classic case of market balancing: greed, fear, and FOMO. Think of winners. An investor allocated shares at the listing price of Kenya shillings 18 and sold at Kenya shillings 50 would have achieved a remarkable return of nearly 178% in a single day. Even at the closing price of 26, investors were still sitting on a gain of approximately 44% from the listing price. And not many investors deliver this kind of return in a single trading session. Then the losers. Investor who bought near the peak at Kenya shillings 50, akifikiria ni bargain, and watched the stock fall to Kenya shillings 26, experienced a paper loss of almost 48% within hours. This highlights a critical investment truth. Price momentum and investment value are not always the same thing. Buying because everyone is buying can be very, very expensive. Key lessons. Number one, don't chase hype. Many investors buy because a stock is trading, but successful investors buy because they understand the business and its valuation. Secondly, volatility in stock market is normal. A stock moving sharply on its first day is not unusual. New listings often experience price discovery as the market determines a fair value. Then three, have a strategy before buying any stock. Make sure you know your entry point, target price, and investment horizon. And finally, long-term wealth beats short-term excitement. So the real question is not what Family Bank did on day one. The real question is, where will Family Bank be in 5 or 10 years from today? Long-term investors focus on earnings, growth, dividend, management quality, and market position, and not daily price swings. And therefore, finally, the first day of Family Bank's listing was a reminder that the stock market is not a casino, but many people treat it like one. Some investors made money because they had a plan. Others lost money because they were chasing excitement or hype, or they were buying because everyone else is buying. In investment, the biggest returns often goes to those who remain patient, disciplined, and focused on fundamentals rather than headlines or hype. The stock market transfers money from the impatient people to patient investors. Now, the question is, what would you have done? Sold at 50, hold it at 26, or bought more during the dip. Ungefanya nini wewe? Shida ni ile ile. Huwezi elewa.